So without further ado, I just want to get right into the conversation. And first of all, on behalf of the Bretton Woods Committee Board and the Advisory Council, I want to thank Faryar Shirzad for joining us. For those of you that have been working in the crypto and digital asset space for some time, you're no stranger to this gentleman. But for many of our members, you may not be aware of his role, the seat that he has been sitting in throughout this incredible transformation in the digital asset industry. And I can say with complete certainty, he'll provide insights and perspective that most of our members have not heard before. I do and must give credit where it's due to longtime advisory council member Lorenzo Binismaghi, who actually hosted a forum towards the end of the IMF week at the Hay Adams, a breakfast forum. I think Faryar, myself, and John Lipsky were the only Americans in the audience, and it was a conversation on the impact of stablecoins and whether or not that was going to be a threat to, European sovereignty. Nothing like that topic for a 7 a.m. breakfast conversation. And I thought Faryar's remarks and his perspective and the way that he mapped it out was so insightful that I wanted to bring him into the dialogue series, and I hope you'll enjoy that. A little bit of introduction, if I can. Faryar is somebody who has really enjoyed some incredible seats at the conversation for crypto. He brings an educational background with the triad of having a finance background, a law background, and going to some small school in Cambridge, Massachusetts for government and global affairs in his academic career. He was an executive at Goldman after being in private practice with many notable DC firms. But the reason he's here today is the incredible leadership and stewardship that he has brought to arguably the most important American brand in crypto and digital assets, that being Coinbase, where he presides over global policy for that firm. And I can't wait to get into that conversation. So Faryar, once again, thank you very, very much for joining us. I asked this basic question of you. I think it would be important, if you wouldn't mind, tell us a little bit about your origin story. You're a traditional finance, you're an attorney, you're working at Goldman, and then you find yourself at this rising comet, if you will, at Coinbase, and in a very, very important role. How did you first get interested or learn about crypto? And I'd welcome some remarks from there.
First of all, thanks for having me on, Greg. I've attended a lot of Bretton Woods events over the years, so it's fun to be on this side of the table, so to speak. The one part of my background that you didn't mention is that I was in government for a number of years. I was one of George W. Bush's international economic advisors. I was the deputy national security advisor for international economics. And the reason I sort of point to that is that it's one of those jobs where there's a bunch of things you need to do, but among the things you need to do is you need to keep an eye on emerging developments that may not neatly fit into what the government is accustomed to confronting and dealing with, and help the president think it through. And so fast forward, I was at Goldman Sachs for 15 years running or co-heading government affairs, including going through the whole financial crisis. And so when I had a chance to join Coinbase after all that time at Goldman Sachs, it kind of brought me back to some of sort of the muscles that I had in the government, in the sense that I understood quickly that crypto is fundamentally an information technology breakthrough that can impact value transmission across the board, certainly for payments, but for capital markets activities, financial services activities, but also really any value transmission, whether it's your data, your information, your identity, your auto title, or what have you. And so this is essentially a paradigmatic shift in terms of how we transfer and transmit value in the world. And so when I got approached by Coinbase to joining them, I sort of felt like it was a chance to go back to 1997 or something and be the guy who has to go around the world, explain to everyone what the internet is. And so that's what I feel like my job is, to go around the world and explain to people what the next generation of the internet is, while people look at me in a puzzled way and say, doesn't the incumbent system work perfectly fine? But I think once the change is implemented, we're all back, and kind of with some bemusement that it was a struggle to get from
Well,
there to here.
well, while you're being the explainer in chief for this conversation today, can you share just maybe a few bullets, if you will, on crypto? Because I think people come into the conversation with a different mindset. And one of the things I'm proud of is that you think about an organization like the Bretton Woods Committee with such deep tradition and roots in traditional finance and the spirit of international cooperation on economic matters and such. But the open-mindedness of this organization exploring the future of finance, I think, surprises a lot of people. But to level set, can you give us maybe a little bit of a couple of bullets on crypto as you see it? Because so many people have a different sense of what crypto is and digital assets. But why don't you take a few moments, if you wouldn't mind, and go down that road, if you would.
Yeah, no, I'm happy to do. I'm actually glad you asked that question. I find it's the most important question I get asked when I do public events. So if you think back at what the internet is a system built on a decentralized protocol that allows individuals to transmit data on a peer-to-peer basis without the need for an intermediary. So let me say that again. The internet is a decentralized, built on a set of decentralized protocols that allow people to transmit data on a peer-to-peer basis without the need for an intermediary. So when the internet was first created, we had this breakthrough called email, and it allowed me to, for example, send data to you, Greg, like for, whether it was a note or, whatever it was. Eventually, the technology allowed us to do things, including set up web pages. So I could set up a web page, you could access it. I could set up a web page anywhere in the world. You could access it from anywhere in the world and read the information I posted on that. That was a gigantic, gigantic breakthrough, technological breakthrough. What the second generation of the internet allowed us to do was to what's known as read and write. So not only could you get on and read my data that I, in a very cumbersome way, managed to upload in this web thing called a website, but the second generation of the internet allowed you to write onto the data that I posted on my website. And so from that, internet commerce, social media, video calls like this one, and so on, were all created. So the first generation was through the ability to do simple transmission of data. The second generation was allowed the interactive transmission of data. And those two things were enormous breakthroughs. Their value is in the trillions in terms of the effect it has on the economy. The third generation of the internet is the one that allows you not only to transmit data, but also value. And so what is value? A value is a unique digital token. So right now, when you think about if I wanted to pay you on the existing legacy internet system, I could send you a picture of a check or an IOU or a picture of a dollar, and then you could infinitely replicate that, and I would have no control over it. And people would have no guarantee that the check, the dollar that you claimed that you got from me actually came from me. You had no assurance that I actually owned the dollar that I purported to send to you digitally. And so right now, the way we transmit value is we send messages to third parties. So in the US, we have a very antiquated payment system, but we perceive it as a user to work actually fairly efficiently. So I just got a haircut this morning. I went, my barber, Venmo. I clicked my phone on it, and she perceived that she got paid instantly, and I perceived that I paid her instantly. Whereas that payment will take 3, 4, 5 days to settle out. And so Venmo is essentially extending credit on my behalf to cover the merchant to make it seem seamless. What crypto allows you to do is to create a unique digital token. So you can have a ledger on which you record a dollar stablecoin, for example, the digitized dollar, or you could have a ledger that records key parts of my information or important items of public record. So land titles, deeds, things like that. And the technology allows you to transmit those things instantaneously, peer-to-peer for almost no cost. And so the first obvious use case of crypto is as a payment solution. So if I want to send money cross-border rather than spending 3, 4, or 5% of the transaction value to send $1,000 across border and waiting for 4 days for the money to move. With stablecoins, you can send it for a few basis points and it moves instantly. But the applications can be infinite. We can talk about it, but essentially you can create programmability and all sorts of things. And that's why there's billions and billions of dollars that are being invested in crypto technology, because everything that we do online where there's value transmission that to date has not been able to be done digitally can now be done digitally. And so that's what's at stake when you hear people talking about getting clarity around the crypto sector. This is what everyone is fighting over.
It's such an important, I love the way you broke that down into first order kind of principles for people. And, after all, when was the last time any of the audience said, I think I'm going to send a cross-border email? We just don't. Okay. And so it's as simple as that. If we can keep it to that in terms of cross-border, what do you mean cross-border payments? It just should be payments. And I think that's much closer than I think a lot of people realize. Let me shift gears a little bit if I can. I think I can make a compelling argument that there's never been an industry that has supported the outcome of a presidential election like the digital assets industry did with the election of President Trump, that has been rewarded so quickly, so handsomely, so deeply, so widely at any other point in American political history. And it sounds like hyperbole, but I think I can back it up. And I wondered if you could talk a little bit about what it was like stewarding a big part of Coinbase's business during the Biden administration, where many people listening have heard about some of the contentiousness between crypto and former SEC head Gary Gensler, all of that business. But maybe just giving us some insight. There were many reports during those days that were often dismissed about something called choke point 2.0. But, look, you were in the middle of all of that maelstrom. And I'd love to kind of maybe get some color behind the scenes and then take us back more towards multilateral digital assets, and we'll go from there, okay?
Yeah, no, it's a good question. So what happened basically, and you have to think about it. For me in particular, having been in Washington for 25, having a 25-year long career, 30-year career before we entered into the Biden administration, I'd never seen anything like it. You essentially had the whole of government approach in the Biden administration to destroy an industry sector, to drive it offshore. And so the strategy basically had two components to it. One was the SEC suing innovators in the crypto sector. Generally speaking, they actually, under Gensler, avoided suing the bad actors in crypto, of which there are many. And what they did is they tried to knock down the big, more reputable companies. And we were the top of the list because we were the only public crypto company, and we were the most vulnerable to being destabilized by a regulatory assault. And so what you had is, in a public fashion, the SEC suing Coinbase, but behind the scenes doing a number of things, some of which we've never talked about in terms of trying to destabilize some of the critical relationships that any public company has to have with outside vendors, let's put it that way. And as you can imagine,
Audits, legal, you go through the whole
yeah,
list.
I won't say it, but yes. And so imagine having the SEC calling your vendors and telling you basically to stop doing business with you. And that was what we were dealing with over the course of the Gensler era out of the SEC. Simultaneously, the Biden bank regulators were trying to choke the industry out. The Obama regulators actually did something similar. It was called Operation Choke Point, where they took industry sectors that were disfavored by the Obama administration and tried to withhold access to banking services. So
for those that were unaware, this was the cannabis industry in some cases. This was the same day, advanced check cashing businesses that were
it extended into oil and gas and carbon sectors that were disfavored by the Obama administration. That ultimately led to a round of litigation and a settlement with the FDIC in particular when the first Trump administration came in. Entered the second Trump administration, and they did the same thing. They were basically, and we've unearthed through FOIA requests, a bunch of documentation demonstrating that the bank regulators were squeezing the banks to withhold banking services. And think about it, I have people on my own team who couldn't get home equity loans, who couldn't open bank accounts, who had their bank accounts closed. So imagine being imagine being kind of an American finding so your access to basic sort of financial services that you need to manage, your daily life. And so what we ended up doing, and this was in mid to late 2023, we realized we were facing, for all of our earnest comment letters and policy papers and lobbying and this, that, and the other, none of it really mattered. We were facing a political attack, and we decided to build the largest political operation Washington had ever seen to respond to what was ultimately a political attack on the crypto sector. And so what I always like to say is that we built a political operation to take the politics out of crypto. And so what you ended up having is enormous success. And people attribute the success largely to the political sort of the super PAC that was involved, that we helped sponsor. I think the part that people underestimate is that there are about 50 million Americans who own crypto. It's a big cross section of the population. They skew. They're a cross section of the population, but they do skew to some extent young, male, urban, to some extent a little bit more than the general population, Black and brown. And so we presented this data to both the Biden and the Trump campaigns. The Biden people weren't interested in it. The Trump people were. There was a gap between the Biden campaign and the Biden administration. Sure. So we went to the campaign. We did the same with the Kamala Harris campaign eventually, and they understood the power of this, but they just felt frozen because the candidate didn't want to diverge from the president. But the Trump people had a broader strategy to attract young males, in particular, low propensity voters, of which crypto owners are disproportionate. What we found is we helped create a group called Stand with Crypto, which now has about 2.7 million advocates. Imagine that, 2.7 million people have signed up to be crypto advocates. Of them, they skew about 60% Biden voters in 2020. They skewed the other way, about, I think, 54% Trump voters in 24. So it was a big swing demographic that was potentially decisive in a number of the swing states.
What would you say? We have a lot of members of gravitas and accomplishment that have similar backgrounds or deeper backgrounds in government or in some of these institutions, Faryar, who they have legitimate concerns about, and I've said this to you off camera many times, I've never seen an industry more willing to shoot itself in the foot than the crypto industry, which of course makes it hard for those trying to do a good job. And you run a large enterprise, and I've run very, very large, highly regulated wealth advisors without crypto, and there are knuckleheads abound, right? I mean, no one's got the market cornered on those kinds of folks. But what would you say to those folks that still just can't shake the cloud of some of the bad acting from the early days of this industry? And what would you say to reassure them, if in fact you can do anything to reassure them?
Well, I mean, it's funny. I mean, think about everything that we've done in the crypto sector, policy-wise and politically. They've been all with one singular objective, and that is to create predictable rules around the crypto sector that apply nationally on a consistent basis. Yeah. And so the irony is, for all the furious efforts that the crypto industry undertook, the goals have been to create clear rules and clear oversight over the sector. And so, for anybody, often the people who don't know much about crypto's response to any of this is, well, they're bad people in crypto. I don't like them. They should just go away. I'm against whatever they're for. But if you sort of thought about it more than that kind of, visceral sort of a reaction, you have to remember what we're trying to do is give the CFTC, the SEC, the FDIC, the OCC, the Fed, the CFPB, I mean, you name your regulator, a clear mandate on what their obligations are in order to provide consumer protection, to ensure the markets operate safely and soundly, to make sure there's transparency and disclosure, all those things that we all want in TradFi in the traditional financial system, we want for the crypto sector. Now, it's a different technology, and the fact that you disintermediate many of the traditional intermediaries is something we should celebrate. Just like the fact that, Greg, I can send you a message without going through the postal service, even if you're across the country, is a good thing. It's not a bad thing. And so the fact that I want to send you money, Greg, peer to peer directly at virtually no cost instantaneously, just like I send you an email, and the fact that I don't have to go through a bank is a good thing, not a bad thing. And and that's sort of what we're all about. So it's hard. It's hard for people. When people say I don't like crypto, I sort of smile because what they're typically telling me is I haven't really thought about this issue sufficiently to have a coherent view, because crypto is fundamentally a technology, and like any technology, you can't be for it or against it. You just have to kind of recognize it's there and decide how you want to deal with it from a public policy perspective. And if your objective is to ban it, then that never works. So the question is then, okay, what's the right regulatory framework?
Well, I won't ask you to answer this, but I'll just make a statement. Let's hope, in the spirit of normalization, that some of what I think the average person that's viewing this industry, I think, has some legitimate beef with conflict of interest right now. It would be unfortunate if this incredible bounty of opportunity that has been placed on the table for the industry is squandered because of reputational risk or conflict of interest that in a downturn becomes a little bit more visible, not to get too Warren Buffett with tide metaphors and all of that sort of thing. But let me steer us back, and I'll just remind everybody that so often, and I make no apology for being unapologetically American. I believe in American exceptionalism, but this is the Bretton Woods Committee, and this is a global organization committed to advancing, again, the principles of international economic cooperation, amongst other things. And I think for a lot of Americans, it's even harder to wrap around these notions because we've been number one. And there's dollar dominance. And we complain about, egg inflation, as the president brought up yesterday at the U.S.-Saudi Investment Forum. But any event, we complain about inflation all the time at single digits. And there are many places in the world where we've seen, hyperinflation and so forth. And so just as a reminder, the adoption rates of crypto in other parts of the world, indeed the developing world, right? The nation states that are clients of our Bretton Woods institutions, if you will, is exponentially higher. So like it or not, it's a part of what's going on. And so now let me pivot it and say, we always try to have our guests look through the lens of the Bretton Woods institutions, look through the lens of the multilaterals, if you will. And I'm wondering, how do you see digital assets, crypto writ large, maybe helping once and for all to advance and maybe have a seismic breakthrough? Is that even possible? Maybe just talk about that. Put your Bretton Woods Committee, your adjunct membership hat on, if you can.
Yeah, no, I'm glad you asked. So I'll start with a very, very basic kind of objective that at least the FSB and the G20 have, but it's sort of captured by what the Bretton Woods institutions do, which is to, I forget when it was developed. It was 2-3 years ago. The G20 created, they established payment objectives, to facilitate cross-border payments. And I think the goal by 2030 or 2035 was to have 75% of cross-border transactions settle in under an hour and have the cost be under 1%. So I think the objective is a 2035 objective. I don't remember now, but it might be 2030. But either way, we are as we speak able to move potentially, if we wanted to, through stablecoins, 100% of cross-border transactions in under a second for under a handful of basis points. Why is that consequential? Because there are a huge number of economies around huge is overstating it, but many, many economies around the world that are heavily dependent on remittances, for example. So think about smaller economies around the world, even Central American economies, African economies, even in India, where there's a significant percent of GDP that's dependent on remittance payments. If you take away the 5 to 10%, depending on how you count the frictions associated with remittance payments, you immediately have, with almost zero effort, a meaningful jump in GDP impact instantaneously in economies like the Philippines or Togo or El Salvador or Guatemala or Honduras or you name it. And let alone the impact on individual households who don't have to pay the frictions associated with those remittance fees. So as just as a simple, basic, lowest of the low-hanging fruits, making payments cheaper and faster is a GDP booster, particularly for economies that are heavily dependent on remittances, which are generally the poorer of the economies.
Mm-hmm.
The second sort of aspect you can think about it is, and you see it generally in developed economies, you see adoption of crypto as somewhere between 7 and, it can be as high as 20%, but let's say 7 and 17% of the adult population. So in the US, it's something on the order of 17, I think it's 17%, 20% of the adult population owns crypto. In a lot of other economies, you see it as well. You see a much higher rate in places that suffer through hyperinflation. So if you're trying to mitigate the impacts of hyperinflation and a financial system that has failed the local population, access to safe stores of value is critical for the population. So places like Argentina, Turkey, other places that have suffered for hyperinflation, you see a huge adoption that people will get their own crypto wallet and use it as a store of value, even as their domestic currency depreciates by the day and the hour. So if you're just thinking about it in terms of just immediate short-term mitigants for people who are suffering in ways that the Bretton Woods institutions are supposed to help, the very sort of low-hanging fruit of implementation of crypto can be, and stablecoins can be, a solve and a mitigator to the distress and duress that these folks face. On a broader level, I mean, the U.S. has data. The average household in the U.S. spends like $2,000 on payment fees. The average household in the U.S. pays $2,000 in payment fees. The average household in the U.S. is unable to manage an unexpected $500 medical bill or a $500 auto bill or some catastrophic, need for cash that they may have. We have the ability to take that $2,000 of payment fees that the average household is struggling under. Greg, the $2,000 just slides off your back. The $2,000 slides off my back. It slides off the back of everybody who's listening on this call. But for our fellow citizens, for most of them, this is the difference between whether they can feed their families in the event of some unforeseen emergency that hits them. So, I mean, you can get into kind of development objectives built around a financial system that is less expensive and more accessible to a broader population to deal with underbanking and debanking. But there's a much more immediate urgency that whether you call it a cost of living crisis, an inflation crisis, a affordability crisis that's impacting politics in the United States and the UK and Europe, all over the world, people are suffering from this hyperinflation. This is a very readily available mitigant that the sooner the Bretton Woods institutions understand the value of will become an ability to immediately become much more responsive to the needs of average people.
Yeah. It's interesting for many of our members. It was so good to see you in October for IMF week. But, honestly, I don't think there were too many people who had on their IMF bingo card that you'd see, Kristalina Gordieva and you'd see Ajay Banga, sitting in between somebody quite well in Mr. Allaire and, our friends at Connexus and Farouk and everybody else on the main stage on a Tuesday talking about stable coins. So again, for our members, this is not so much if you can't beat them, join them. It's just these things are happening, and it's important to lean in, maybe even a little bit further. But I did want to pivot more deeply into the stablecoin conversation. One that you participated in at the tail end of the aforementioned IMF week. And once again, I don't think there's been anything as profound, at least in my memory, as with one stroke of the Sharpie, signing that Genius Act into law and the second and third order effects that it has had, both here in the United States, but that conversation was largely through a European lens. But can you double click a bit more into how you see the stablecoin kind of moments that we're seeing here in the United States, this normalization that's taking place, and maybe kind of draw from some of your comments on that terrific panel that Lorenzo fielded last month.
Yeah, I mean, even in the 4.5 years I've been in the crypto space, it's been a huge evolution. I think when I first got into it, there was an enormous skepticism from the establishment institutions, the BIS, the Basel Committee, the IMF, academia, you name it, the more established think tanks, about whether this technology even mattered. I think people had a hard time understanding, separating the crypto trading from the value proposition of the underlying technology. What you then began to see is a bit of an evolution where, like, a lot of the institutions began to understand the value, but became very protective of what the role of governments in terms of the traditional roles of the government and the traditional relationship between finance ministries, central banks, and the banking sector. I think what we've seen since the Genius Act has been implemented is that there's been a very healthy reassessment that technology has brought us to a point where the traditional architecture of the financial system is going to adapt, just like it's adapted every decade before, in the face of a new technology that allows for people on a peer-to-peer basis to transmit value without the need for an intermediary, which is what this is ultimately about. And so since the Genius Act went into effect I guess, or was signed into law, it's not yet into effect.
Yeah.
We had something on the order of like 90 separate stablecoin related payment announcements made by different market participants. So it could be people that have built the networks on which the stablecoin payments can transfer, new stablecoin themselves, payment solutions announced in partnership between different companies. We ourselves are a big infrastructure provider at Coinbase, so we work with others doing this. So the adoption has been faster than I've seen in almost any other piece of legislation. Even before the bill has actually gone live, people understand that this is the future. The debate that occurred during the IMF World Bank Week, Greg, that you were a part of, has a couple of flavors to it. One is there's still a bit of a debate in some places, not in the United States, but in Europe in particular, over essentially saying, okay, we get it. The technology is a far superior value transmission technology, and we get the payments are going to adapt to this better, more efficient, more resilient payment mechanism. But we feel uneasy that privately issued stablecoins under regulation could be a significant payment mechanism. And instead, we prefer a central bank issued digital currency. And that's basically where the Eurozone is. The ECB has been very protective of what it perceives to be its prerogatives to be responsible for the digitization and tokenization of the euro. And so the MiCA framework, which is Europe's crypto asset regulatory framework, basically is designed largely to contain the adoption of stablecoins in the Eurozone until the ECB is able to launch its central bank digital currency. And I can talk about how successful I think they'll be or won't be. But the US in particular, and most of the other jurisdictions around the world, I think understand that the technology is so moving so quickly that a government solution is probably not going to survive in a very competitive market of currencies. And so what the US has done is they've adopted something called the Genius Act, which is the US framework for stablecoin issuance. So that first debate is CBDCs versus stablecoins.
We've had it here.
CBDC, the US is stablecoins. Most of the world, I think, will go to stablecoins. And then the second question is, okay, among the regulatory frameworks, is the Genius Act a good bill or a bad bill? And the Europeans, I think, worry that Genius is somehow a race to the bottom. David Frum in The Atlantic just today put something out arguing the stablecoins are terrible. And I can help address that. The Genius Act is actually a pretty strong piece of regulatory legislation, and I can talk about that if you're interested.
Well, if I may, it would be wrong for me to not bring up the topic of stability, when so many of our notable members here at the Bretton Woods Committee are passionate about the subject of stability. I personally believe stability is underrated in many aspects of modern life. But maybe can we double down on just the stability implications? Like, role play that out, game, take it from your perspective. By the way, we assume these are your opinions and your comments, not those of your employer or anything like that. But if they are, we don't mind that either. But in all seriousness, stability. We've done significant thought leadership around that topic as it applies to these established institutions, prudential banking, et cetera, et cetera. And many people do argue that, listen, this is not the holy grail to preserve U.S. dollar dominance. If you're for that, I happen to be. But actually, this will be a major proliferation of stablecoins, will actually be something that destabilizes and has that kind of destabilizing impact on the global markets. So I'd welcome any thoughts about that.
Yeah, well, we share the view on stability. It is critical that the dollar be the dollar and it be strong, resilient, and hold its value, regardless of the technology through which it transfers, whether it transfers through paper mechanisms, through the ledgers of third-party financial institutions, or through a token. So that's a given. So that's one point I'd make. The second point I'd make is it's important to remember that issuing a stablecoin is different than running a bank. There's very little in the financial system that's riskier than running a bank. What a bank is a credit intermediation institution. It takes deposits. Let's say it takes $100 of deposits, and it lends out $1,000 to borrowers. And in that regard, it plays a really important function in the economy, where it connects savers to investors. And in between, it has to manage the fact that it's lending out 10x, 100x of the money it actually has to borrowers. And so it does all sorts of complicated things, including assessing the risk, the creditworthiness and the credit risk of the borrowers. It makes predictions regarding the depositors' propensity to come in and want their deposits back. But what the government plays a gigantic role in allowing the banking system to operate. And so they provide deposit insurance, and they provide systemic risk backstops. They provide access to a discount window, and emergency liquidity assistance, and then FDIC receivership, and you name it. There's a million different measures of public policy that are intended to take a extremely risky and complicated undertaking, which is banking, and have it largely work. Although we have bank failures all the time.
We do.
And sometimes they can be systemic.
Yeah.
A stablecoin issuance, Greg, sorry for the long lead up,
please.
Is a very, very simple undertaking. It's essentially a technology service. So you want a tokenized dollar because merchants now will give you a discount if you buy a piece of merchandise using a stablecoin, because they don't have to pay all those bank fees, for example, or the cross-border ACH fees or what have you. So what I do as a stablecoin issuer is I take your dollar. Let's say you give me a paper dollar. I give you back a tokenized dollar. I then take your paper dollar and I hold it in a secure account subject to audit and oversight. And I don't lend it out. I'm not allowed to lend it out. I have to have 100% reserves against every dollar that I issue as a stablecoin issuer. And I can only hold it against cash and cash equivalents. So I can hold it in cash. I can hold it in short-dated treasuries, and that's about it. And the way I make my money is I earn the float. I earn the interest on the underlying reserves. You get a tokenized dollar that is issued by a genius regulated. This is the federal legislation that just passed. Overseen by the OCC, subject to audit requirements, disclosure requirements, transparency requirements, prudential requirements, capital requirements, and so on, with 100% backing and no credit intermediation and no fractional reserve banking. So there's always this sense that you get the Europeans will say this and others will say that, well, the banking system is so safe and stablecoin isn't. This stablecoin issuance is a extraordinarily vanilla like undertaking. And there have been bad actors in stablecoin space. And that's why we push so hard for there to be a federal law around this so that we would have the OCC overseeing the sector and you'd have all sorts of prudential and other transparency requirements associated with it. So the debate now, you'll see is, whether what the role of the bank should be and this, that, and the other. But generally speaking, people have to understand the banking system is complicated and the government's got a million measures that it has implemented to backstop the banks because they fail all the time. Not because I'm criticizing the banking system, but it's just the nature of how hard that high wire act
Yeah.
of credit intermediation is. Stablecoin issuance is a very, very vanilla business. There are some risks within that we can talk about. But anyway, I think as a starting point for the discussion for the audience, I think that's an important sort of level set as to what we're talking about. And then
I appreciate you. Yeah, I appreciate, forgive me. I appreciate you framing it in that regard. And I know there's still going to be plenty of room for debate on this topic. Those that have had any meaningful conversations with me that were not traumatized know that when I look at crypto, I look at it through a rational exuberance lens, but leaning forward into it. And I think we still have a long way to go to get there. And, speaking as somebody who, in all seriousness, was responsible for very, very large retail wealth management business lines for American Express and Ameriprise Financial, that what concerns me most, we don't have to answer this, but what concerns me most, just note it, is that this is the first time, literally, where everyday consumers are getting exposure to novel products, not through traditional distribution lines and financial advisor channels. It's the first time where consumers probably know more than a certified financial planner or even a CFA, for those of our CFA members tuning in. And I think that's concerning. And I think that's something we need to wrap around from an institutional level and from a regulatory level, and certainly from those FINRA type organizations that I think are even further behind. It's certainly a new day in Washington from a regulatory perspective. I'm going to start looking at our questions that I know we have queued, but I'm going to give you a quick and easy one. Recently, Coinbase made the decision to remove its status in Delaware and move south to Texas. There are some members, Coral, who have been talking about this Y'all Street migration to Texas for some time. Can you give any, inside baseball on kind of what that decision was all about, if you can?
Yeah, happy to. I mean, the one thing I would say though is we continue to operate out of two New York DFS regulated entities. So we reincorporated out of Delaware into Texas. But from an operating kind of perspective, we continue to be what we were before, which is a global business that operates primarily out of two New York Department of Financial Services regulated entities. Our exchange operates under DFS BIT license, and the custodial business that operates out of a New York DFS trust charter. So I just want to say that from an operating perspective, the impact of the move was not nearly as significant, as you may think. In terms of reincorporation, I'm not an expert on kind of the developments in the Delaware Chancery law, but there's been a lot of commentary. I think we've all seen that decisions that were much more predictable in the past, particularly when you've got a founder-led tech company that has a structure kind of like ours or Tesla or others that are led by founders who are still active in it. There's enormous uncertainty now regarding how the Chancery Court potentially will determine some core governance decisions that I think all of us assumed would be resolved one way, but with the advent of a couple of judges on that Chancery Court, now are all been called into question. And I think just from an obligation to our shareholders, we felt like that uncertainty was just too hung over the institution in a way that made sense for us to find another jurisdiction where we could get the kind of predictability we had in the past.
You know, out of deference to somebody that our members might know, a William Dudley, I'm going to ask one of our questions that we have here in the queue. And Bill asks, if you wouldn't mind, could you please comment on Governor Chris Walker's proposal to offer skinny accounts to settle payment transactions at the Fed? Is it too restrictive? And the follow-up there is, do you see it as just the first step with further liberalization once regulations are put in place vis-a-vis stablecoins or the Genius Act? A good bit to unpack there, as one might expect from a question from Bill. Coming in hot from West Virginia.
What was that game show? I'm gonna use my helpline to call Bill Dudley and have him help me answer this question. Well, he'll have a better answer than I do. I do think the paradigm of the banking sector being the access point for payments is one that needs to be re-examined. Governor Waller's proposal was very high level, and then I think he made some clarifying comments afterwards. So to be honest, I haven't dug into it really because it felt like it was a really interesting and important conversation starter, but not even at the point of like a concept release yet. But we've commented publicly on kind of, I think, the point, the directionally where he's trying to go. And I think it reflects some of what you saw, like Andrew Bailey, for example, the governor of the Bank of England, gave a really important speech a few weeks back as sort of a scene setter before they put out their proposed framework for systemic stablecoins in the UK. And he asked sort of more broadly and more fundamentally about, or he made the point more fundamentally that the purpose of regulation isn't to preserve the role of the banking sector in a manner that remains unchanged in perpetuity. There's evolutions that are going to occur. And I think having direct access to Fed master accounts for non-bank institutions that are important in payment processing, I think is something that's definitely should be on the table.
So I will apologize in advance to our members that have submitted questions if we don't get to you, but just trying to do our best to stay on track here. Let me go to Rodrigo Valderrama, which is fun to say, number one. But number two, his question is, where do Forex pegs to each transaction enter the equation in a remittance, for example? Not sure if that's something that you can touch on a little bit. So where do Forex pegs to each transaction enter the equation? I'm not sure if that's something you can hit.
No, I mean, the normal exchange dynamics between currencies are going to remain, notwithstanding the currencies themselves being, moving on token, as in tokenized form. But I don't know the FX market enough to really know if I understand that question, frankly, Greg. So I apologize.
All right, nope, that's fine. I appreciate your candor. Question from newer member Rex Wempen, if I can, on how you see the tokenization of commodities evolving. In other words, what role do you foresee Coinbase playing here? Maybe you can break some news for us. Who will the main competitors be from where you sit? Is this something that you guys think about as having competitive advantage in terms of the tokenization of commodities, Faryar?
Well, most crypto tokens are themselves commodities. And so you have a very active commodity derivatives. I think people on this call know that CFTC is not a commodities regulator. It's a commodity. It's a derivatives and futures regulator. And there is a very active crypto commodities and futures market that operates under CFTC oversight as we speak. And so if the question relates to the futures and derivatives markets, those are live and operating in crypto world under CFTC oversight through the whole architecture of, they're cleared through DCOs, operate through DCMs and FCMs. We operate an FCM and a DCM, and these are the essentially the broker, the exchange, and the clearinghouse under the Commodities and Exchange Act. And so we operate our crypto business in that regard. What the question may be getting at is the tokenization of real world assets. So the way the way crypto works is it's fundamentally an information technology breakthrough, and the way the basic pillar, the starting point of it is you need to have somebody a verified, trusted source, or for example, the government, for example, that issues a thing and records the ownership of the thing on a tokenized ledger that it maintains. So a really good example would be um, something that the Commerce Department, I think, just announced, which is that they're going to start putting government statistics out in tokenized form. And so what you can then do is you can create smart contracts that immediately can access the tokenized data that the government has issued in order to execute smart contract transactions that potentially may have a contingency on um, economic data that might be issued by the government, for example. And I think the Labor Department may be thinking about putting labor statistics in tokenized form. In California, auto titles are now recorded in tokenized form and maintained on
Yeah.
blockchain-based ledgers. A lot of other governments are putting public data or government records in tokenized form. Once you have the data or the thing, the ownership record maintained in a token, it then allows people like Greg and me. Greg owns the token. He owns the title to his property. He can then convey that property to me uh, instantaneously for almost no transaction fees. And then I will be recorded on that public ledger by virtue of that blockchain-based transaction as being the new owner of the title to his house that he just transferred to me. So he transferred his house to me. The records are public and immutable. So all that kind of title insurance, for example, becomes the need for which becomes obviated because you'll have chain of title maintained through tokenized form on these public blockchains that can't be corrupted in any fashion. So you'll see the entrepreneurs around the country that are looking to disrupt the title insurance market through tokenized land records, for example. So anyway, so it was a bit of a convoluted answer, Greg. I hope I
No, but it
clarified.
actually touched on many of the themes that we're wrapping up in one of our tokenization papers, our first, and a couple of the other questions really do get to novel products of the future and how those could be compelling. The next question comes from David Cervantes, who is a prominent member of the tokenization working group, applied several compliments to the combating illicit finance being a part of your global policy agenda. I know you guys have taken a lot of arrows in the industry, and in some cases, people could make a compelling argument, justified. But on the whole, I think he points out you've done a great job trying to lean in. Looking ahead, though, he asks, what does a functional, privacy-preserving trust architecture for crypto actually look like to Coinbase? In other words, do you see a place for verifiable credentials, agent authentication, and network embedded compliance primitives? So fun to unpack there.
It's a really good question. The short answer is yes, 100%. Um, uh, the need for people to authenticate their identity and to authenticate their eligibility to engage in X or Y is a really important thing. And having the ability, for example, for me to get KYC because when I onboard to Wells Fargo or JP Morgan or to Coinbase, we all have to go through the same thing. So if Greg wants to open a Coinbase account, he'll go through the same KYC with us that he would with JP Morgan. Once Greg is KYC'd, we should be able to issue Greg a KYC token. And so the wallet address associated with Greg will then have a KYC token that demonstrate that while the wallet owner of this 14-digit alphanumeric wallet
Yeah.
has been met at KYC requirements and been screened for sanctions and illicit activity and what have you. And so we don't need to know that the wallet belongs to Greg Johnson. We just need to know that that wallet owner is a cleared individual. And I'm going to go on a little bit of a detour here, Greg, because I think it's important.
Take it. Take it and run with it.
So generally, if you talk about it, when Greg and I, if I go to Greg's house, I say, I'm going to mow your lawn. And he says, okay, I'll give you, whatever, $20. The fact that there's no public interest in the government surveilling my decision to mow Greg's lawn and Greg's decision to give me $20. That's covered by a number of sort of principles of privacy that we have, including Fourth Amendment protections against unreasonable search and seizures. Now, if I go to Greg's house to buy drugs and the government has some cause to think that Greg's a drug dealer, then they can go to court and get, subpoena, subpoena, do surveillance, do whatever, wiretaps. But that principle that there is no presumption that every transaction should be monitored by the government is a really important one, unless there's the government's ability to show some cause to break through that Fourth Amendment protection because we have evidence that they're able to demonstrate in court of illicit activity. And I think that's a really important one to keep in mind because what the Supreme Court held maybe 30, 40 years ago was if Greg pays me through a bank when I mow his lawn, Greg and I have abandoned our Fourth Amendment protections. We brought in a third-party intermediary to intermediate the transfer of value from Greg to me. And we have, by virtue of having done that, abandoned our Fourth Amendment rights to privacy. And so what the government's built is a whole framework of surveillance now where that bank has to surveil the transaction and do SARS reports, for example, if they perceive that there might be evidence of illicit activity associated with that. Now, the whole SARS process is a joke. It produces like 90% false positives, but nonetheless, it's the system.
It's a high number. I'm not sure if it's 90, but it's a super. You may be sure it's a high number.
It's a 90%. Yeah, it's a very high number. Crypto forces us to re-examine that paradigm. If Greg is able to transmit value to me, not just in cash, but he can send me a tokenized 20 tokenized dollars to me from his wallet to my wallet. Have we abandoned our Fourth Amendment rights to privacy? Does the government have a surveillance right to examine Greg's transmission of $20 to me? I think the Supreme Court's ultimately going to have to decide this. I think the short answer, in my view, is absolutely not. If there's evidence of wrongdoing, for sure. If there's not. And that's what the issue is with crypto. With crypto, you have the ability to have your own self-hosted wallet. It's basically a piece of software that allows me to hold the keys to my assets. Greg will have one as well. The fact that he wants to send me $20 is not of the government's business unless there's some evidence that we're engaged in illicit activity. And I think this is not that different from the arguments we sort of got on, encryption for texting, or even when the internet first came around. It's a change in the paradigm when you don't have an intermediary. And a lot of the struggles that you see policymakers are undertaking is that we've assumed a certain system because technology forced us all to use intermediaries. And now that we don't need to use an intermediary, we have to rethink, go back to first principles.
I can hear some of our FinCEN alumni buzzing in my pocket right now. I'm just telling you, number one. Let me do this before I ask you one parting shot question, but I want to apologize to Wesley and to Paul and to Warren, who I did not get to, and also Anonymous, which I'm pretty sure was a plant from Kraken with their IPO pending. So I'm not even gonna do that. But Emily, you do ask a really good question from our executive director, Emily Slater. Can you just give us a couple? I know we're at the end here, but can you possibly give us a couple of bullets on what you view the strengths and gaps of Genius? Now it's there. We're in review and comment, all that, blah blah blah. But it would like a couple of the strengths and a couple of the gaps if you were having final say.
It's an excellent framework. It obviously has to get implemented, but it does everything you basically want. It has all the belts and suspenders, the audits, transparency, reporting, reserve requirements, liquidity, prudential. I mean, you name it. It specifies redemption rights that you have as a token holder, Greg, or I would if I show up to the issuer and say I want my dollar back, with the circumstances until I would get it back. The regs haven't been written yet, but it's an excellent framework. Our big gap that we think is that because of lobbying from the banks, stablecoin issuers cannot share the interest on the reserves with the token holders. It's a crazy system. It's a crazy thing that Congress put in there. It's a real miss. The banks are actually trying to expand that to cover third-party rewards programs in the Clarity Act. But I would say that's the big miss.
So you do not believe in the potential for massive flight risk of deposits. So you do not believe that.
No, because there's no evidence for it. I mean, there is a general organic shift away from deposits as you see people accessing things like mutual, money market funds and other savings vehicles. But it's
No, I don't blame any industry for lobbying on their own behalf. But anyway, I'm going to spare everybody else the rant. And what I will do is I will say on behalf of the Bretton Woods community, thank you very, very much for joining us this afternoon, providing your insights. Obviously, this is a new industry that's moving very, very quickly. And certainly we appreciate your leadership and your candor today. And wish you nothing but continued success, Faryar, for you and your colleagues at Coinbase. And to everybody else, on behalf of the Secretariat and the Advisory Council, best wishes for those of you celebrating the American Thanksgiving next week and for the balance of the festive season. Thank you all very much.